October 4th, year 2025. Today, I'm going to discuss the presentation of financial statements. And in this presentation, I'm going to talk to you or walk you through with Mijano Raman Retail Export and Import Corporation. This corporation is a fictitious name. So the copyright with respect to this presentation, the material that is displayed on the screen, it belongs to me. So let's go through a few things before we discuss the case in a detail. So there are three types of financial statements. One, audited. Number two is review engagement. Number three, notice to readers. Audited statements, they provide the highest level of assurance. Review engagement provides some sort of assurance. And notice to readers, it is purely compilation, but it doesn't provide any assurance. Okay? So the assurance is, so what does that mean, an audited financial statement or audited financial statements? What it means is that so it would have the accountant would solely, state that they perform their responsibilities. Okay. And in this case, I am the preparer of these financial statements. I'm also the auditor. Now, in real life, if you prepare the financial statements, then you will not be able to audit the financial statements. Okay. So it's just for demonstration purpose. All right. So again, so I prepared these statements for you for demonstration purpose, and also I provided the assurance with respect to this financial statement showing on the screen, which is Mijano Raman Retail Export and Import Corporation. Now, it could be any other name. It could be Mijano Raman Retail Export and Import Inc. Incorporated or Limited. Okay. Now, this is a snapshot of a financial statements that you can see. This is what it would look like in real life. This is what you would see. So this is the first page. So if you go to a large publicly traded corporation, you will see their financial statements is, they would have a audited financial statement or audited financial statements with the accountant signature, accountant information, and the details with respect to the auditor's responsibility, the management responsibility, and the opinion with respect to what degree the financial statements is presented in accordance with IFRS. IFRS stands for International Financial Reporting Standard. Now, you don't need to follow if you are not a publicly traded corporation, or if you do not want to follow IFRS, you can simply follow the P GAAP or SPE, private entity GAAP, or also known as GAAP. So, as I said, the financial statements, audited financial statements would provide the highest level of assurance. Then the review engagement and the notice to readers provide no assurance whatsoever. So to have audited financial statements, there are certain things that you need to follow. Only few or limited, large corporations that do, or certain corporation that meets certain criteria that do provide audited financial statements. Okay. Now, sometimes the corporation, they can ask you for audit. Well, not the, so let's say if you went to a bank, they might ask you for audited financial statements. This doesn't mean that they will give you what you want, right? So you want to raise fund for your corporation and you are looking for audited financial statements. This may not give you, the even if it is provided the assurance, the highest level that is presented with the accuracy and presented in a manner that is that is standard with the IFRS, doesn't mean that you will be given that opportunity to you'll be given the given the fund that you're asking for or seeking from public or bank or lenders. Okay. So, so don't just waste your money with respect to lending, because lending is different. Okay. They want to make sure that you have liquidity. You have a lot of assets. There's a lot of, risk criteria they go through. Okay. And the risk premium goes up, whenever you don't meet something. All right. So in an audited financial statements, you would have auditor responsibility, management responsibility, and opinion. The opinion would provide that whether it's unqualified opinion, meaning is that the financial statement is produced and presented with the IFRS, okay, at the highest level of accuracy that is possible, or the statements is prepared and presented fairly in all material with respect to IFRS, okay, fairly. So when you see the word fairly, that provides some sort of, well, not some sort, an audited standard assurance. Okay. So now let's go to the notice to reader. So the notice to readers is this, you can see that it tells you that this financial statement, or in this case, is unaudited. Accountant provides no assurance of accuracy with respect to the financial information. The purpose for the statements is to provide feedback to the management, lender, or shareholders. So if you have good, if you have a lot of money sitting in the bank don't even want your financial statement, they'll just give it to you in any way. Okay, so let's say if you have $1 million sitting in a bank, they'll say, well, here you go, $100,000, $200,000, or several $100,000 worth of loan or line of credit to, to meet your, hedging strategy or, interest deductibility option. Okay. So again, the accountant, their qualification would set out in the notice to readers. Okay, if they're CPA or whatever they have, and this is the income statement. In IFRS, they call it a statement of profit and loss. So the GAAP says the income statement or the statement of profit and loss in generally accepted principle, accounting principle, it is known as income statement. So the old timers, they are used to income statements or a statement. So the company has a revenue of 500,000 and cost of goods sold is 125,000 in their retail division. This is the retail division. Okay. And it has, labor, CPP, and then the rent for the retail operation is 60,000. It has the commission expense for sales for 100,000, and the insurance expense for retail store is 5,000. Vehicle insurance is 7,000. Interest expense is, for whatever the reason they have interest expense, that is 1,800 or $1,837. They might have a credit card, whatever it is. We'll go through that later on. And this interest expense could be from the long-term loan, but we'll take a look at that later on. And then we have depreciation expenses for vehicle, leasehold improvement, and depreciation expense for equipment. Okay, so you can see the highlighted in yellow. These are depreciation expenses. These are non-cash transaction. Okay, and this is our total expense. And so after this, so we have a revenue and cost of goods sold in this right here. I'm going to highlight that in cyan, maybe in dark, whatever you call it. That is the, yeah, maybe in green. Okay, so this is the gross. So revenue minus cost of goods sold is the gross profit. So if we click on this cell, you would see 500,000. So we'll have 500,000 minus 125,000 is our 375,000 is the gross profit. So what is the formula for the gross profit? So the gross profit is the revenue minus the cost of goods sold. Okay, also known as COGS, cost of goods sold. Okay, so this is how we get the profit, the gross profit. Okay, so this is how we get our gross profit. And with respect to the total expense, so we just simply, this is our expense section right there. Okay, so maybe we can just insert something and say this is the expense section. And say expenses. Okay, so it could, if you want, we could bold it. And so in the revenue section, we have this revenue, and then we have the gross profit. So maybe you could just simply say, this is the, we don't want to identify this. Oh, we do actually. Okay. So we could say this is our gross profit section, okay? The highlighted in green. And this is our expense section, okay? So we know what the formula for gross profit is revenue minus cost of goods sold, okay? In general, so you'd have income equal to revenue minus expenses minus taxes, okay? Perhaps you could just leave it there. Revenue minus expenses is the income, and net income equal to So maybe perhaps you can say income before taxes. Okay? We can say that, and we could say net income is income before taxes minus the tax expense, tax payable or tax expenses. Tax expenses, okay? So few things we need to know is the definition of income is sales. So you could also say income equal to sales, sales minus expenses, okay? So the income equal to sales minus expenses. If you want to go to accounting term, you might say that the income before tax, revenue minus expenses. Net income is the income before tax minus the tax expenses. Gross profit is revenue minus cost of goods sold, okay? We need to have these terms so that you're aware of that, okay? So this is our gross profit. This is the, maybe perhaps I could unhighlight this. I could say there, okay? So if we put this into a green color, if we take this off, okay, so anything you see, this, the cost of goods sold, the expenses highlighted in green, this green section is our expense section, okay, and this is our highlighted in pink or orange, oh, it's pink kind of, revenue, which is also known as sales, okay, right? So we know that for now. We know sales, income equal to sales minus expenses. So this is our highlighted in orange is our sales, highlighted in, maybe we can change it to green, is our expenses, okay? So now let's remove this so you know how we get to this formula, okay? Income equal to sales minus expenses. Right, so now, so this is how we get the net profit. Or we could say, if you don't want to say net profit, you could say net income, okay? Net income before tax from the retail division, okay? So in our case, we have quite a few division, and I'm going to take this highlight off, okay? Okay, so if we sum these expenses up, okay, to meet this certain standard in the presentation, we do want to show it in two different sectors. One is the gross profit, and then the expenses, and after that we would have our net income, okay? So net income before tax. So this net income before tax is right here, okay? I'm going to highlight that in, oops. Okay, net income before taxes is gross profit minus the expenses. So you can also simplify that further. net income. So we can take this over here and say net income before taxes is gross profit minus expenses. Okay, you can also say that. Okay, this is how we do the presentation of the financial statements. So now let's unhighlight this so we know how it in real life, how the presentation works. Now the company has retail division. You know, you run a business, you might have a retail division. So let's say when I was young, I first started my business in retail division in 2004, October 10th, October 13th, I think. Don't quote me on the date, it's been a while. So in October 2004, I started my retail venture. So I start off with the retail division, okay? And later on, I moved into exporting, okay? Not exporting, but importing. I wasn't involved in exporting, but I tried for some reason back then. They didn't allow me because whatever the limitation I had, so I couldn't get to the exporting goods, okay? So in this case, we have the retail division. So from the retail division, we have net income before taxes 100. I'm going to highlight that yellow. $141,371. How did we get to that? We got revenue minus cost of goods sold equal to gross profit. I'm going to highlight that in green, okay? Okay, revenue minus cost of goods sold is gross profit. Gross profit, so we put all of our expenses and we create total expense, or we sum it up to total expense. So if you look this up, this is nothing but sum of this column, okay, right there, this section of the column. So this gross profit minus the total expense highlighted in red. Well, it's kind of, the ink is red, you can see it right there, 233,629. Okay, so the gross profit minus the total expenses would give us net income before tax from the retail corporation, from the retail division. Okay, so now let's move to so we have our export division right there. Same way, we have our revenue. I'm going to unhighlight this too. Okay, so you don't get confused. So you're working on this section now, export division. Okay, I'm going to highlight that in green. This is the section that we were working on, the export division. So you can see revenue minus cost of goods sold gives us gross profit. I'm going to highlight that in yellow. Okay, can you see in this yellow cells right there? So that's how we can cover gross profit. Then we have our expenses. Okay. Now I don't want to make it like the other one, but we can, if you want, we can just simply insert 2 rows above this, and we could say um, expenses. Okay. And if you want, we can make it bold. So again, we learned this earlier right over here. I'm going to copy down. You can see the income equal to sales minus expenses. So I explained that to you earlier, how that works. Okay, so let's go through this again. The expenses, we have expenses is this much right there. So a total expense would be $34,400. So I'm going to unhighlight this. Okay, so this gross profit, which is right here in this cell, minus this total expense, which could be administrative, could be something else, highlighted in yellow, as you can see, will give us this net income before taxes from the export division, highlighted in yellow. 175,000 minus 34,400 is $140,600. Okay, right. And then we have our, let's think of this. Okay, so we have, let's bring this cell over here. So we have this corporation, and the corporation have quite a few things. This is the corporation. The corporation has retail, export, and import. Okay. So if we maybe I could just unbox this. So let's just start over again here. Okay, so this corporation, this corporation has 3 divisions: retail division, then we have export division, and then we have import division, right? So 3 divisions right there. Okay, so now in addition to these divisions, they would have management, right? So the management could sit into an admin office, like a head office, right? So this head office, they also have it also has its expenses, right? So these guys over here generates revenues and expenses. This division over here, head office, only creates expenses. to manage the operation, or expenses to oversee the operation. Now, each division, this retail, they could have their own managers, directors. This export division, they could have their own manager and employees and so forth, right? And then the head office would have their own expenses, but head office does not generate any revenue. Okay, so be aware of that. Okay, the highlighted in yellow right here, you can see it has revenues and expenses. The head office, it doesn't highlight it in maybe in blue, okay, or green, whatever you call it, blue, I think. This head office, it does not produce any revenue, okay? It only has expenses. Does not, so maybe I could say, the head office does not produce revenues or sales, okay? It doesn't. It only triggers expenses, right? So that's the head office for, to manage, to oversee the corporation. So who sits here? The CEO. CEO stands for Chief Executive Officer, okay? The CEOs, the the president, okay, presidents. Usually in this division level, you would have vice presidents over here, okay? In each division, retail division, they have vice presidents or managers. Okay, so they might have vice presidents or manager. Okay, now here this CEO is usually a director. A director has the authority to bind the corporation. A president could be a director. Okay, a vice president could also be a director, but usually it is very rare. Okay, they can be. So CEO, they can be a director of the corporation. Some cases you'll see the what do you call that? The signing officer of the corporation. The signing officer of the corporation is, he may or may not be a director, may or may not be a director. Okay. Oops. So what is the key term? An officer of the corporation, usually a director. An officer of the corporation is a director. Often, okay? Often, not always the case, okay? So usually, because they would need a director to do certain things. So let's say only a director can have, can bind an agreement. So let's say the corporation, went for lease, to lease a place, and it would require a director to bind the corporation. A director can only bind the corporation. Okay, so we know who are the officers of the corporation and officers with a special power. A director, usually an officer of the corporation that has the binding power. Okay, they can bind the corporation. Okay. So now we know our net income from the export division is 140,000, and net income from the retail division is highlighted in yellow. Okay, you can see that these two divisions, the net income before taxes from the retail division and the net income before taxes from the export division, are the two major sources right here and highlighted in yellow. Okay, I'm going to point, say it A and say it B. Okay, right there. Okay, so these two division only produces revenue and income. Okay, and the net profit before the taxes from the maybe I could say the operation, not the entire operation. Okay, so this would be, if you add this A and B, these two highlighted cells, $141,371 plus $140,600 would give you, highlighted in, I'm going to highlight that in yellow as well. Okay, $281,971. Okay, so that is our export division. And then we have our administrative division, which is the administrative expenses. Okay, so the head office. Remember I said head office, it does not produce any income. It only has admin expenses. Okay, so what it has the office expenses, rent for the office, the labor, the other expenses, and the total expenses from the administrative department is $92,708. Okay, I'm going to unhighlight this so that you don't get confused. Okay, very important. Okay, so this is our C. Okay, let's put it to C, mark C. Okay, and so let's say this is our D. Okay, so we're working on these two cells right there. I'm going to highlight that in orange. Okay, C minus D, that gives us this profit right here. Okay, so let's call that E. Okay, so we have this right there. And then, so we know that the admin has, so admin has no income. So it's simply expenses. So we just simply subtract that from the net profit before tax from the operation C minus D. That will give us the net profit before tax, which is the $189,263. Okay. And then how do you get the tax expenses? I'm going to show that to you later. Okay. Remember I said earlier remember what I said earlier, that the head office, the admin, it doesn't produce any income. The head office, it only has admin expenses. So we just simply subtract that from the net profit and the admin expenses. Okay, so that would give us the net profit before tax. This is a multi-layer accounting statements, might be a little difficult for you, but I would have a simplified one coming up so that you can see. Okay, it is very important for the management to see whether this particular operation is profitable or not. Okay, because this value is produced for the business owners, they need to make sense. They need to be able to see whether their operation or particular operation within the operation is profitable. So in this case, if you run the analysis, you'll see that the retail division is less profitable from the export division. Okay, you see that? Even though the export division has less revenue than the retail division. The retail division has 500,000 and the export division has 300,000, but the expenses significantly less. Okay, so this allows the managers to make better decision. All right, and then we have our so we know the net income before tax minus the tax expenses will give us the net income. So net income, which is right here, we already found it, C minus D, that gives us the net income before tax. So you're working on this area right here. Okay, I'm going to highlight that in green. Okay. So I am working on this particular, I'm working on the net profit before tax, the box E, which is right there, minus the total expenses, tax expenses, sorry. So the total tax expenses, which is the F, okay, this green section right here. So E minus F, that'll give us G, okay, G equal to E minus F. What it means, coming back to this net profit or net income before tax, you could say net income before tax, less I could just add the word less there if you want to make it accounting, to make you an accounting pro. Less tax expenses would give you the income from operation after tax. Now, what I was going to tell you that these tax expenses, okay, it's a completely different thing. Okay, it's just one line. Okay, your tax proportion for the entire year is just one at maybe a section of the financial statements. Okay, so if you take a look at our, this is the tax preparation section. Okay, slightly different. So you can see instead of the depreciation, it has the CCA. Okay, capital cost allocation, and then you would have, I've done it, slightly the same way so you can understand it. Okay, understand it better. Okay, so we come to a net income for tax purposes from the continued operation. Now, in this case, net income, you'd have to go and see my previous presentation. I'm going to bring that up for you so you can take a look. Okay, just a second. So if you go to this is my, I previously prepared the tax preparation for you. So if you watch one of those videos right here, it will walk you through how to prepare taxes. Okay. So this is the channel where you can go to. Okay, there are quite a few videos there. You could go through it. Oops. Okay, so you could go through these videos and see what, where you can. There are some cost videos, cost accounting videos for cost accounting, investment accounting. I was going to produce the more investment accounting videos, but I thought before I produce that, you need to get the basic understanding of the tax preparation. Okay, so this is a very basic. So again, this is the tax preparation. We had to get into that. Okay, this is the tax preparation. Okay, so this 39,000 came from our tax preparation. So this sheet right over here. Now, don't get confused with the continued operation and discontinued operation. I gave you a bit of taste here so you can understand, what it means, the income above the line and income below the line. So in this case, I was a bit creative because I didn't want you to get confused with the discontinued operation, the taxes, and how it affects the financial statements. Okay, but the way I prepared it, the tax amount before and after the discontinued, well, let's put it this way, there isn't significant income from the discontinued operation. So there are two sectors. One is the operation held for sale, and the other one is the discontinued operation, discontinued or disposed. Okay, may not be disposed as of yet, but so this, in our case, it had. Let's not go through this right now here. So our net income from the operation after tax is 149,000 highlighted. I'm going to highlight the cells in yellow so you could get the understanding. Okay, right there. $189,263 minus $39,349. Okay, that gives you the net income from operation for tax. I apologize. The net income from operation after tax. So our after tax income, you can also say after tax income. Okay, also known as AT. Okay, so if you're a finance student, so you would know EBIT, income or earnings before interest and taxes. Okay, so EBIT less taxes less interest. Okay, so that would give us after tax income. Okay, EBIT minus the interest expense and taxes expense for taxes. Okay, now the tax preparation It's just one line or one section in the entire financial statements, okay? All right, so now I'm going to move to the discontinued operation. Okay, for simplification, the income from discontinued operation is not included in the balance sheet or cash flow, okay? But the way I prepared it, even if you include it, it didn't make any difference. All right, so beware of that. Even if I were to include that, it would not make any difference whatsoever. So would only work above the line. So anything, so you see that line over here, the line, the big bold black line, is known as anything above and below, okay? So maybe you could just, so income above the line and income below the line, okay? This is very important. Income above the line, highlighted in yellow right there, is very important for an investor because they want to make sure the continued operation is profitable. Okay. So in our case, so the operation held for sale, a corporation could have those big, large corporations. I don't want to name one, but if you know, if you know that there are many corporations. They're multinational corporations, right? They have operation in China, Brazil, India, Pakistan, Bangladesh, Vietnam, Myanmar. So many places they might have operation running, and each country they have a different way of structuring their corporation. Okay, so the same way a corporation of the so let's say a corporation running in a multi or international corporation, and that international corporation is also located, has a branch in Ontario, Canada, and that might have various section. Okay, so um, so let's not, without that, let's go to the discontinued operation. So discontinued operation is something that they discontinued, or they put it on they put it for sale. That is discontinued, or income. Anything that comes from those sectors or those operations is considered to be income below the line. Okay, so again, the same way we got it here, right here, the fundamental of accounting is the same. Revenue minus expenses is the profit less taxes, and then we arise to net income after tax. But prior to that, I want to go back to the income above the line. Okay, highlighted in green right there. You see that earnings per share is very important. Okay, or how do you get the earnings per share? Very simple. So our EPS equal to income divided by total numbers of common shares outstanding. Okay, so EP is equal to income divided by the common shares. Okay, so in this case we had 149,000. I'm going to write it here. $149,914 was our net income after tax, divided by, we have common shares 100,000. So 100,000 is our common share. If we divide that, that would give us $1.49. If we round this off uh, to decimal, that would give us $1.50. We could make it $1.50. Okay, so that is, this is how we get our EPS. We also wanted to, often the shareholders they want to know the EPS from the continued operation and the EPS from discontinued operation, so they can make a strategic decision with respect to the investment they're about to make. Or someone could be interested in buying those discontinued operation if they see that they're doing a really great. So let's say, for example, this corporation, they want to get rid of one of the warehouse. Let's, for example, one of the retail stores. They could just say, well, this is our discontinued operation, and we want to have it, we want to sell it, right? And when they see that, when an investor or buyer see that oh, look at this, they have the earnings per share positive here, it's, they are earning, 15 cents, it's still profitable, let's buy it. Because sometimes it's very difficult to structure a corporation, because the company could have a goodwill, company could have good employees, right? It's very difficult for, you could have money, but you may not be able to. So think about this. If you want to open a bank, you won't be able to do so. It's very difficult. You have to get, to open a bank, you'd have to get letter of patent. You would have to comply with the Bank Act. Okay, you would have to follow all the regulations. You have to meet the financial liquidity. Okay, it's very difficult for anyone, overnight to open a bank. It is almost impossible. Okay, so if a bank they might, for example, a bank want to sell their discontinued section, which is very rarely, but they would probably end up selling the whole bank. But you get the idea that the EPS from discontinued operation is very important, because an investor could buy that discontinued operation. Okay, so in this case we have, I strategically placed this two section here. One is the operation held for sale. I'm going to highlight this in pink. And operation discontinued. No, maybe I said it wrong. The pink is the operation held for sale. I want to sell this division. And this one, operation discontinued, that means, it's completely probably discontinued, something within the thing that is running for whatever reason, or, they have some fixed cost. So that, that triggers the expenses. They might have a building that requires mortgage paying, or they probably have, they probably had some leftovers, product, and they sold it. And from there, they had some revenue, okay? So as you can see, the net profit from these two sections is exactly opposite. What do I mean by that? Highlighted in yellow, okay? See, the revenue and expenses exactly, not the revenue expenses, but the net profit is 20,000 from the operation held for sale and 20,000 from the operation from the discontinued that is about to be disposed, okay? So they offset, right? So you really don't have anything from the discontinued operation. So now we want to get our basic earnings per share calculation. How do you do that? We just simply add these three, the EPS from the continued operation and EPS from the, I'm going to see if I could, let's unhighlight all this. Now let's give this cell right here, earnings per share. Let's highlight these cells into, yellow. Right there, yellow cells. Okay. If we hide this from here, maybe it will allow me to. Okay, so the earning from the above the line is 150. So we have $1.50 less this over here, EPS from the operation right there, held for sale. So I'm going to type it manually, less 0.15 less the EPS from the discontinued or the operation that is about to be disposed right there, which is negative as well. Okay, so I'm going to make that, I'm going to put that in a bracket. Okay, so we don't have, okay. So that gives us 1.5 right there. So this is how you get the basic EPS, basics earnings per share. Okay, so let's highlighted all the cells in yellow. Okay, now the way you calculate DPS for the continued operation and discontinued operation, there isn't any difference. Okay, the discontinued, the EPS calculation is always the earnings, which is the net income after tax, divided by common share outstanding. A company could have, when you go to incorporate your articles of incorporation, so I've been into the accounting industry many years. So in 2004, when I first incorporated my corporation, Designer Bargain Incorporated, I had an option how many shares I could authorize the corporation as a director to allow the corporation to have the corporation to issue later on. So it could be any number. It could, you could have 100 shares, or it could have 100 million shares, okay? Or you could say unlimited, any number it can issue. So a corporation could have millions of shares, they're authorized, okay? So authorized meaning is that in the articles of incorporation, perhaps I can show that to you here, maybe. So let's say this is this is an article of incorporation. Here is articles because there's quite a few articles here. But this article would include, I don't have the all of it. It would include how many shares this particular corporation can issue and authorize. So at the beginning of the get-go, when you set up the corporation, it will tell you, now this corporation you can see was, I registered in October 13th, 2004, okay? So October 13, 2004. So this is another article of incorporation, which is it's a federal corporation. The same way, it would ask you, and also to tell you that who is the board of director of the corporation. Okay, so so it's very important that you oops. So you know what an article or article of incorporation look like, okay? So you'd have to structure that of article of incorporation. You could handwrite it. There are some benefits of writing it in hand, and there are some benefits to writing it in doing it federally. What I mean by the writing it in hand, sometimes it could be a victim of identity fraud, okay? So if you have your but it's very unlikely. It makes no difference whether you could handwrite it, the article of incorporation, or you could type it, okay? But you want to be professional, so you could type it. But anyway, so let's go through this. So far we know that the so far we know that the EPS comes to a big play when to make sure that the investor wants to make sure that your corporation is profitable, okay? It's very important for you to know that. Why? Because if you are not earning, then the investors would not invest in your corporation, okay? Or the bank would not lend you money. So this is not a course about it's not a course, but it's not a presentation about the ratios. Ratios are very important. Your liquidity ratios, your asset to debt ratios, your earnings per share EPS ratios, there are many ratios, there are hundreds of ratios, right? And those are very basic. So in your first accounting course, accounting courses doesn't teach you the ratios, but the finance does. So let's say in 2007, when I've done my first finance course at the Ryerson University, the course is called Finance, I think CFN 300. That is, that course provide you with the ratios. And the another course, there are quite a few investment courses. So let's say there is another, each university might have a different name for it, but this, I'm producing this video many years after, right? So when I went to the finance, when I've done this finance course, that was like 20 years ago, 2006, right? We're 2000, yeah, nearly 20 years ago. Can you imagine that? But anyway, so the reason I mention that is because this is not a finance course, but as an accountant or accounting student or a business owner, you would need to keep track of your ratios. It doesn't provide a good indicator. It does provide some meaningful assessment of the corporation. How is it running? But it does not provide an in-depth understanding of the corporation. Okay. So what it means, now let's move to this section right here. You must be really tired by now. It's very basic. I mean, this is not even detail accounting. I mean, it's very basic, right? This is not in-depth. So what it does is that this section provides you with the dilution. So what it means dilution, like how could my corporation have diluted EPS? What it means, like what it means basic EPS and what it means the diluted EPS. I'm going to highlight this over here, okay? This section up there. Okay, so this highlighted in green, light green, or kind of lemon color, I think. But anyway, so you can see that what it means, dilution. Okay, so we have a basic EPS. Now, as you will know later on that the corporation sometimes they might have common shares, they might have preferred shares, they might have different classes of shares, okay, class A, class B, class C, class D, different kind with different restrictions attachment to it, right? So we know for sure the common shareholder is the shareholder that gets paid after everybody else, but they have more say to the corporation. They can control the board of directors. Now, as a director of a corporation, you may or you may not be the shareholder. Often than not, a director often owns more than 50% or 100% of the shares, right? So directors can own 100% of the share, a director of a corporation, or may own a little bit, right? So it depends. So the shareholders are different. Shareholders is the shareholders who owns the corporation. A director is an officer of the corporation. So now, why did I get to that discussion? The common shares and preferred shares. The preferred shares often they come with, in this case, they come with cumulative and participating, I guess. So I want to get on that feature again. And preferred shareholders, they have more um, advantage often. They cannot vote, but they have more benefits. They might have more benefits or competitive advantage over the common shareholders, or may not, right? So it depends on the terms that the preferred shares comes with. So when a preferred share, they declare dividend, right? And 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 that could trigger dilution, right? Or they might have preferred shares with convertible features on it. So let's say, or even common shares, right? Or not common shares, the bond, right? So sometimes bond could have convertible features. So bond could convert from, so let's say bond worth $1 million, it could convert to, let's say 50,000 common shares with certain exercise price. I'm not going to get into the finance course, okay? It's very difficult to teach accounting or finance. You'd have to exercise, you'd have to practice, you'd have to go through a lot of learning process. It is almost impossible for someone to teach you this. Okay, someone can show you the way you can learn, but you'd have to learn it on your own. Okay. So the dilution occurs because of the stock. Let's say they have stock options, okay? That because of that dilution could occur. So in this case, the company they issued, they declared 40,000 dividend, and it remained unpaid. Okay, and because of the preferred dividend declared, it would affect the available retained earnings. Okay, so I could say diluted net income. It's not a proper term for it, but you could just say that diluted net income or diluted retained earnings, but that's not the proper term. But this is for you to understand it. And the convertible features have, in this case, 10,000 convertible features they had within the preferred shares. They could convert that at any time when the price is right with a certain exercise price. So let's say, the market price. So let's say, for example, the strike price is $1 and the share market price for this particular company is, let's say, $2. You know, they might decide, okay, well, he has 10,000 shares, 10,000, he can convert to 10,000 common share from preferred share, and that would give him $10,000 again right away, right? So many reasons often could be control of the corporation, right? So let's say the company is doing really well, and the preferred share has the very lower exercise price, and they can exercise that. Again, this company has, so these are the highlighted cells that could affect our I'm going to highlight that in yellow. These are I'm going to highlight that in a different, maybe blue, okay? Now we declared we had, remember, we had 100 right there. We had 100 highlighted in blue, $149,914 earnings, right? So you can just simply take this off, this 40,000, right there. And we could say that we set that aside for the preferred shareholders, right? That's their rights. Okay. So after paying off this $40,000 from $149,914 less, right there, less the 40,000, give you $109,914. Okay, right there. We're working on these blue cells right there. Okay. So now we know this is the income available to common shareholders. So now see if there is any possible more common shares available that is not, that is already not outstanding, but possibly could, they could exercise the right. So the preferred share has the convertible features of 10,000. So that 10,000 could come from preferred shares. They can easily convert. And then employee stock option has, another 5,000. They can also exercise that. Okay. So total And then we already have, this is not, has not been exercised yet. As you can see, there's a possibility that they might exercise this right. Possibility. Okay, I could say these are possibilities. Okay, that, and these possibilities gave the dilution. So we have, if we add these three cells right here, I'm going to highlight those in. If we add these cells in red, you can see that it would give us 115,000, possibly, it's not the proper name, the diluted common share, right? It's just not. It's just, these shares are, maybe I can say that shares that give, that is used to calculate diluted EPS. So shares that are used to calculate the diluted EPS is 115,000. Okay, so if we just simply divide $109,914, because we had to remember we had $149,914 less the 40,000 that is, payable to dividend, payable to preferred shareholders. After that, we have only $109,914 less, not less, but divided. If we divide this number by 115,000 shares, then we would have 90. This is the cell right here. 0.9557774. If we round this off, it would give us 96 cents. Two decimals, so we have EPS 90. Usually, it's 4 decimals, so, but we want to make sure that you understand it, so we could just simply format these cells and say, okay, well, we want to keep that 2 decimal to 4. Okay, usually that's the proper way to go, 0.9558. Okay, so our diluted EPS is 96 cents or 0.9558 cents. Okay, since remember we declared dividend for preferred shares, but we didn't pay, but we'd have to book that. Okay, so we'd have to say, well, retained earnings we'd have to debit that for 40,000 and dividend payable for 40,000. Okay, this is something that you would have to look in, but I didn't. I'd have to take a look at the balance sheet, so I may have incorporated that or I may not. But this is to give you an idea. But focus on the income above line. Okay, it's very confusing for anyone. Okay, so focus on the income above the line. Okay, if you are an accounting student, or anything below the line gets more confusing, and it's very tedious. Now, these income statements does not include the comprehensive income. Okay, but under the IFRS, it is required. You could either you prepare the statement of profit and loss and comprehensive income together, or you could do it separately. I prefer to have it separately done. I didn't show that here, okay, because this particular corporation has no comprehensive income. Now let's move to balance sheet, also known as the statement of financial position. Is very important. Now keep in mind, we are only working above the line, but if you do think that you are working on the with respect to the entire corporation is fine the way it created this, it would make very less difference because there isn't any significant cash flow or tax liabilities from the discontinued operation that could affect the cash flow or balance sheet. But it does affect the income statement significantly. You can see that, right? Because one part of the discontinued operation, the operation held for sale, is profitable by 15 cents EPS, and the other one is 15 cents, negative 15 cents EPS. That is about to be disposed. So whether I recommend you to not to look into the discontinued section because it could confuse you. The reason I gave that extra ingredients to the business owner so they can understand when they read the financial statements what it means. Okay, they would have to rely on an accountant. Now, who is an accountant? A person who has accounting designation, who has certified advanced CPA accredited certification, advanced accounting, or basic, maybe prior to 2010 there was basically a certification, but after that and after 2016 they separated that into 4 sectors, the CPA Ontario. So they've done it, I think, I'm not sure, but I think they offer it in 4 different segments. So the first certification, then the second one, third one, and fourth one. But in my time, it was one time, actually, one time in 2010, and after that, it's separate to 2000. No, yeah, 2016 or 2017. They have it done 2. So 2016, they did it for 2 sections. The first section of the certification, the second one, right? And the second one is, it's probably about, it's this, you would need this certification to be a CPA. Like, this is CPA accredited education. So you would need this to write your CPA if you want. This is equivalent to master's courses, okay? So let's take a look at this without going into too much nitty-gritty of who are accountants, and anyone could be an accountant with the education, okay, diploma or certificate or bachelor degree, but make sure that the education is CPA accredited. So let's see here. It's already 1 hour 28 minutes. So if you want, maybe perhaps I can discuss the balance sheet at a later time, but this is what it would look like, balance sheet. So what balance sheet is? The statement of financial position. So it has assets section. The asset section comprised with long-term assets and current assets. So it has 2 segments, current assets and long-term assets, highlighted in red, ink, and yellow, okay? So if maybe I could highlight that to different color, pink. These current assets plus long-term assets give us the total assets, okay? So in this case, the corporation had $920 cash sitting there. The checking account had $245,718 cash sitting there. These two nowadays, this is considered to be cash, okay? This could be petty cash, okay? You could just say petty cash, okay? But let's not say that. I don't like to use the word petty cash. Just simply say cash, okay? So we have account receivables of 105,860 dollars, and then tax assets. Remember, I talked to you about the um, the timing differences from the capital cost allocation and depreciation expenses. Remember this? There was CCA, this CCA, and let's see, highlight in yellow, okay? CCA and depreciation right there. This gave um, the triggered tax assets, okay? It could be because of the timing differences, right? But in this case, this arose because of the depreciation policy was lower. It triggered lower amortization or depreciation than the CCA allowed, okay? But this is, CCA is actually this is actually fourth year course, okay, at the bachelor's degree. So if you're doing your bachelor's, this is your fourth year. In the last year before you graduate, you probably deal with the corporate tax accounts just right before you graduate, okay? So this is our balance sheet. So we know what assets are. There are classification of assets. It's current asset and long-term assets. We could take a look at this. And the reason I highlighted the tax assets because I wanted to give you an idea where that come from, okay? And then we have our long-term assets, which is the vehicle, leasehold improvement. Now, accumulated amortization, it's actually accumulated depreciation, maybe I should say. The amortization and depreciation is the same thing. It's just a different name, okay? Because the depreciation is used in the IFRS, and the GAAP use under the GAAP you are required to use the name amortization. Under the IFRS, you are required to use the name depreciation. So the total asset the corporation has now. Here is the things that you would have to pay attention to this, okay? Remember, every year you amortize or you depreciate the vehicle, the accumulated amortization would go up. So let's say this year it is, at the beginning you bought it for 50,000. The first year you had an amortization of $9,167. The next year you would have another $9,167. Could be more or less, okay? So as you can see, okay, so your vehicle value just your vehicle book value, this is known as book value, okay? This is known as book value of the vehicle. So after the first year of amortization, The book value of the vehicle is $483,833. If the market value goes up, so let's say for an example, it went to 50,000. Okay, market value, or let's say residual value, not market value. Residual value of the vehicle in the market is 50,000. So the residual value of the vehicle in the market is 50,000 and the book value is 40,000. There is, if you look at this, you there is something not right. Okay, maybe I could just say, maybe I could show this to 45,000 instead of 50,000. Oh. So the so this is your fair market value, your FMB of the vehicle is now 45,000, but your book value is this we are dealing with. Okay, your book value of the vehicle and the FMB of the fair, of the vehicle is your fair market value is higher. And something wasn't right with the policy. Okay, because usually when the fair market value goes up, gain, and that would trigger, readjust, revisiting the policy. Okay, why that gain, and you would have to address that gain through the income statements. Okay, but we are not going to talk about that. It's very detailed. Okay, it just, it gets more complicated. It's a very basic, so I'm going to clear that. So don't, by watching these videos or by getting access to this document somehow, this document won't be public, but you should at no time, if you don't have accounting education, you shouldn't prepare this. And accounting education from college, so if you have a diploma from college, at the university level, they would only give you first year. Okay, so be aware of that. So our total asset, after we add this up, the equipment, so we have vehicle 50,000 less the accumulated depreciation, leasehold improvement less the accumulated depreciation. Beware of that lease with respect to CCA, because this particular lease, if usually they're for 5 years, okay, unless they have a renewable, the lease must have a term that you are allowed to renew it. You can't renew it, then you'd have to amortize that for 5 years. So in this case, the depreciation is $18,333. Okay, equipment you bought it for $10,000, and the cumulative depreciation is $2,292. Okay, building, 100,000. Again, if the building has gain, the IFRS requires you to address that. Okay, yeah, because this particular building is for investment. Okay, you can see that. Okay, so these things that deals within the comprehensive statement of the financial, the comprehensive section of the comprehensive, it would go under the comprehensive income. Okay, It may not. Sometimes it could go to the income statements under the unrealized gain, but often if the investment is held for held for not sale, held for trading or held for maturity or long term, then it might go to the comprehensive income. Okay, you'd have to take a look at this where it could fit into. That's why you'd hire an accountant who can deal with this. And usually, you learn that later on. At the first year, second year, you wouldn't learn that. Okay, you would learn that in third, fourth year, or some cases in masters in accounting. Okay. Now, if you look at the video, this video right here, the investment accounting, the mergers and acquisitions, it's a very, this is where you'd learn the, nitty-gritty of the how, where the comprehensive income would fall in. Okay. Some cases you would learn that in the second year courses, right? But again, this is not for a student. It's mostly for business owners, so we don't get into that. So the liabilities, so again, it has two sections, asset section right here. I'm going to highlight that in green, and then this is the asset section. This section is the liabilities and shareholders equity section. That I'm going to highlight that in green. Okay, so if we put it together, you can see there are two sections. One is the asset section and the liabilities and shareholders equity section. Okay, so asset and liabilities and shareholders equities. Okay, the asset equal to liabilities plus the shareholders equities. Okay, so this is they're equal, right? So the asset is $50, then your liabilities plus shareholders equity. So you could have $25 liabilities, and then perhaps I can put a sign there, and $25 shareholders equities. Okay, so total would be $50. Okay, so this is the liabilities and shareholders equities section where you get to, now I'm going to work on this section. I'm going to unhighlight the entire cell. So we're going to work on this section here. Okay, let's highlight that in very light color. Okay, so this is where we're working on now. So we have liabilities section right here within this liabilities. So I'm going to highlight that in light pink or peach color, and then we would have the shareholder section right there, that we can color that to plum. Okay. So the liabilities and shareholders' equities has two. It has two sections: liabilities and shareholders' equity. Okay. So in this case, the corporation has accounts payable 50,000 and bank loan 100,000. So this 100,000 really was used to, you can see it's very, very vivid for the leasehold improvement. Okay. Often, if you go to the bank, you would say CSBFL. Okay, a small business loan. Often they use that to for the leasehold improvement. Okay, so this is our long-term liabilities, 100,000. Total liabilities, this 50,000 plus this 100,000, that gives us 150,000. I'm going to highlight the cells in yellow so you could see that. If you add this, that would give us 150,000. Remember, I showed you earlier that a corporation could be authorized. In this particular case, this corporation is authorized 500,000 shares, and outstanding and issued is 100,000 shares. Okay, so the shares were selling at $2 per share, and it has 2 voting rights per share. Okay, these are the conditions. You could add that in the shareholders agreement or the articles of incorporation. So that would give you 200,000. So 100,000 times 2, it's very simple. This is the 100,000. Even though the company can issue 500,000, it wasn't sold the entire 500,000. It was only sold 100,000 shares was only sold. So when you see the word outstanding, outstanding simply means right here. But it means this is what's sold to the issued and sold to the shareholders. Okay, so very important for us to know what it means. Okay, authorized means authorized equal to the maximum the company or the corporation can issue. Okay, so be aware of that. Okay, so preferred share authorized. The corporation can only authorize 100,000 preferred share, and in this case, outstanding the entire 100,000 at $1 per share, that is 100,000. So the shareholders equity section, this is how they raise share fund to start the company or raise the fund to later on if they need money other than loan. Okay, the company can raise fund through financing. If it is financing, then it's a liability. Often means liabilities, and financing through shares, which is which in this case could be through issuance of shares. Financing. This is not, this is not, not a liability, okay? Not liabilities. The preferred shares sometimes might have an attachment saying that they would have to, you know, redeem it. If there is a clause, then they would have to reclassify that, and that would get more complex, and you would have to address that through the notes and disclosures, and it could possibly you might if there are any breach to the condition, you may have to recognize that as a liability, but you'd have to disclose that to the notes disclosure section. Okay, so we have common shares. We have 200,000 common value of the common share is 100,000, but the value of the common share is 200,000. So don't get confused, okay? And then we have preferred share, and that gives us the total numbers of share right there, okay? And remember, I told you that whether I'm going to book the dividend payable, I didn't. So for some reason I didn't. I have omitted that. So if that was the case, then you would have a current liability of dividend payable right there. Okay. So you'd have you would have insert dividend payable. Okay. So you'd have to recognize the dividend payable 40,000, and something else would come to play. But I didn't include that here just to give you an idea. Okay. So we have in the shareholders equity section, we have 200,000 raised from the common shareholders and 100,000 from the preferred shareholders. And retained earnings, we have 149,000. So that would give us 449,000. So let's have an example. If we do decided to, so this number would go down to 149,914 less 40,000, and the liability section would go up by another 50,000 right here. Okay. So that would go up by 50,000, actually 40,000, not 50,000. Oops. Okay, so there'd be 190,000, and you would have this reduced by 40,000. Okay, the total is still the same. Okay, 500. This is the cell. I'm going to highlight this cell, two cells together. Let's pick that into red. Okay, and we're going to change the color to white. Maybe another color, green. It just doesn't. Okay, so maybe yellow. Okay, so 599,914 total assets. The total liabilities plus the shareholders' equity is still the same thing, the red cell, $599,914. Okay, the exact number. Okay. All right. So So it really doesn't matter, okay? So I'm going to take this off so that I don't make mistake in the cash flow. This was to show you, okay, that how the number could come to play, okay? And this is our dividend payable. Okay, it's still the same thing. So now let's move to cash flow. So you can see that these two red cells right there, if I were to hide this, hide, you see that the total assets and total liabilities, these two red cells are exactly the same, okay? Remember the equation I showed you earlier? If I have to bring it down here, so in this case, we have 599,000. I'm going to make that the whole number. Okay. Right. So that is the highlighted in in yellow. And then if you were to add these two, if you were to get our total liabilities, then we would unhide this, and then we would get our liabilities from here. So that would come from 150 plus this shareholders equity, okay? So if you add these two, 150 plus $449,914, so if we add these two, this 150,000 plus the $449,914, that would give you exactly the same number, okay? That's the cell, right there, okay? So liabilities plus shareholders' equities would give you the total amount for the assets, okay? So it's more complex than that, okay? So don't just go, you saw this and you know everything. No. Oh, cash flow right there. Again, the cash flow is the way I prepared is it's slightly different. So it's an indirect method. What is it called? An indirect. There are two methods: the direct method and indirect method. Sometimes you need to prepare both to make sure that your cash flow is accurate. It's called vouching. This is an accounting auditing term, and often the auditors might use this vouching, but if you prepared it under the indirect method, they might use direct method to vouch, or they might go through the cash flow. Usually the vouching is different, but I just want to give you an idea how they might use the direct method. Vouching, tracing, it's different. Okay, you trace things and you vouch. Okay, I have this to support this. I have this document. Okay, that's vouching. Okay, and trace it something you don't have something. You go back and start looking for it and you trace it. So you have net income of $149,914. This number would be different. It would be if I had what do you call that? If I had reduced net income or retained earnings, but let's not get into that. Okay. So we have the increase in account receivables. That means cash went out. So the corporation can, when they sell something, they could sell it in cash or account receivable, ACR. Okay. So let's say you have $500 in sales. You have $10 in cash and $40 in ACR. So what it means that when the account receivables went up high, your cash reduced. Okay. Well, how so? Because think, if you didn't have this account receivables, you would had, oh, I think it's $100, you would have $500 in cash. Now, since you sold $400 in ACR, your cash went down to 100, right? If you hadn't sold into ACR, then your sales would be equal to cash amount. But since you didn't sell it to full amount in cash, you only got $100 in cash, your ACR went up. So your company has less $400 cash. Okay? Or if it had zero cash and $500 ACR, then your cash went down by $500. So any amount that is sold in account receivables, you would recognize that as a cash out, that you don't have access to that cash. Accounts payable the same way. Let's say you bought cost of goods sold, CO, maybe inventory, I could say. I didn't show inventory here for some reason. I was supposed to, but I didn't show that. Usually you would have inventories, okay? So the inventory, so let's say the inventory costs, so let's say $500. Let's say $600, okay? And you have two options. Either you could pay cash or account payable. Means I owe you, okay? Account payables means I owe you, and account receivables means you owe me, okay? So let's say you bought inventory for $500, okay? So you have an option. You could pay $500 cash, then the company, your cash would be out. So let's say you had $1,000 in your hand, okay? Total cash available to you. So let's say $1,000, okay? From that, you paid entire $500 this purchase. You had 1,000 in hand, you paid entire amount in cash, so you have $500 cash left. Maybe I could say, let's say inventory worth 400. Okay, so you don't screw this up. 400. Okay, so you have cash in your hand 600. Now let's say, for an example, instead of paying 400 in cash, you paid 300 in cash, or let's say, you know, 0 in cash. You paid the entire amount in accounts payable, 400. What happened to your accounts payable or cash in hand? Your account payable went up and cash increased. Remember, your cash, you only had $600 right there. And because you chose to pay no cash and you paid it through account receivables, then cash went up from 600 to 1,000. So the account receivable, increase in account receivables, you have more cash came in. That means, you have access to more cash in. And tax assets is something because of the tax assets, remember the CCA, right? You get those benefits in the way of tax back or reduced tax created in tax assets, okay? And your amortization was lesser, your tax base, amortization or depreciation was lesser. Remember I showed you earlier? Let's see in the notes disclosure here, okay? Remember, this was the, so lesser depreciation than CCA. So vehicle was 13,000. Your depreciation amortization was less than CCA amount. So this cash really came in back to you in a way of tax incentives, okay? You got tax incentive. Cash flow. So that would increase your cash in. So anytime the tax asset comes in, it would increase your cash flow. Okay, and then you have depreciation expenses. What it means that when you have a depreciation expenses, it means that this is a non-cash transaction. It's a non-cash transaction. So what it does, when you have a non-cash transaction, depreciation is a non-cash transaction. It has no effect to the cash flow. Okay, but in contrary, CCA has effect to the cash flow. Okay, so be aware of that. It may not be often than not. Okay, so CCA that triggered in tax assets that brings cash back to you. Okay, otherwise you would have paid this amount. And then you have the financing activities. So you know that you financed through common shares. You finance the corporate. This is not a liability. Remember that. So 200,000 came from the common share, and then preferred share 100,000. You got loan 100,000, and cash out from the leasehold improvement. You spent $100,000 in leasehold improvement. So you have cash flow from the financing activities. So remember, cash in, cash out, because you have to pay this to the contractor to renovate your place, business place. So that's why the cash went out. So your financing activity is now 300,000 total cash flow from the financing. Now remember, you have operating cash flow right here. Is if you sum this up, that would give you the operating cash flow. This is our operating cash flow. When the operating cash flow is positive, it's a good thing. when the financing cash flow is, could be high. It depends. If you have a loan in the loan covenant, it could, it could give you certain concerns, going concerns. Okay, so instead of having, if you had a lot of loan, instead of 100,000, if you didn't have this 200,000, everything was, let's say, your common share was zero, preferred share was zero, everything you raised was $400,000 from liabilities, your company is already insolvent. Okay, so you'd learn that in the financing term. Okay, why the company is insolvent. Okay, so the insolvent is when every dollar asset that you have, so let's say asset and liabilities. Okay, so if you have $500 assets and if you have $500 liabilities, then you are insolvent, literally. Okay, that's a rule of thumb. In real life, it might be slightly different. The cash flow from investing activities is, remember, you bought the vehicle. Okay, that's an investment. You bought an equipment for the place, right? You see the balance sheet right there. This vehicle right there, the vehicle, the equipment. Okay, the equipment and the building, these are investment. Okay, now I did omit the leasehold improvement can often also be an asset. For some reason I didn't include that here. um, so I would have to take a look into that. It is really an asset to the corporation. Okay, so this is a pro forma, just to give you an idea. Okay, so um, we have, now I would probably have another term here. They actually, no, it's right. So because I already, it's actually a financing activity. So I showed the leasehold improvement as a financing activities, not an investing activities. So it's perfectly fine. Okay, so the equipment and the building. So the investments is the vehicle, equipment, and building. Now, some might argue that leasehold improvement is, it could be an investment, but since it was used from the financing activities, so I used it towards the financing. Okay. So the net increase in cash flow is, if we add these three, operating cash flow right there highlighted, cash flow from the operating activities plus the cash flow from the financing activities and cash flow from the investing activities. Okay, so that would give us $246,638. Okay, so this, if you add this 246,000, where this come from? If you go to your balance sheet, 246,638. If you go to our balance sheet items right there, if you add this petty cash plus this checking account, it's highly liquid. It's considered to be cash. It is $246,638. Okay, so it would match the cash flow right there. Okay, so if we bring this from balance sheet, if we cut it and put it next to cash flow right there, maybe over here, it's exactly the same number. You can see that. Okay, that's the ending cash. Since there was no beginning cash because it was a new corporation, you'd have to provide under the IFRS, you'd have to provide the notes and disclosures. So you could say notes to the financial statements. You put the corporation name, then whether it's income statements or balance sheet or cash flow or notes, you put that and then you date it. Now, beware, a lot of people, they don't know if you put as at October 31st, 2025, this doesn't represent year end. Okay, so you leave it like this. This means year end. So we know, note one, the financial statement is prepared under the IFRS. Amortization, it's actually depreciation. Is based on a straight line basis, and the corporation purchased the vehicle on cash. Accounting policy for depreciation is a straight line method over 5 years. Okay, so I showed you that over here. Okay, so this is the debit, and this is the credit to the depreciation for 11 months. This is the corporation purchased the equipment on cash. Accounting policy for depreciation is a straight line method. Again, the built-in kitchen, commercial range, griddle, grill stove and counter, $10,000. So it's there. Credit the amortization on a straight line basis for 5 years, 11 months. That is $2,292. This is also known as a T account. Okay, and you show that over there. The corporation purchased the building on cash. The unrealized gain is minimal, no OCI. OCI means the other comprehensive income, okay, or comprehensive income. So in this case, because it's unrealized gain for a building, it is, most likely it's an investment property. It would go to under the comprehensive statement OCI, a statement of comprehensive income and other comprehensive income, something like that. Okay. The company started the first year operation in February 1st, 2024. Fiscal year ends December 31st. This is also known as a short year. You would know this, okay? You would not know this from your school. You'd have to practice, okay? And next year, you'd have to use that fiscal year end. So you'd have to choose that on the preparation. If you go to, I'm not going to show that's in a tax course, so you'd have to choose the short year end, okay? And company use first in, first out cost of goods sold policy or accounting policy. So lentils the FOB point. Again, it shows the FOB point between the shipping method it is. You know the difference between FOB point and FOB destination. Big difference in cost recognition. Okay, it would play a very big important role. Okay, liabilities often than not. Okay. So company own no back taxes. If we don't have any back taxes, we'd have to give that disclosure to the bank or the shareholders. Common shares each authorized 500, outstanding 100,000 issued share price, well, market share price in the book value, actually. Maybe I should say the book value. The share price is maybe I could say at so you could say the share $2 price. You don't have to point it out because since it's the first time you showed it, the book value in this case equal to book value of the share equal to market value of the share. Okay, so you really don't have to, that's why, because this is just the first year. There isn't probably any benefits to that. Maybe not, but this is the beginning time, right? And preferred shares, again, I discussed that before. And the features in the preferred shares is participating cumulative at 4%, callable on the third year anniversary. So meaning is that this is what triggers the liability section. Okay, so if they can't pay it back, they would have to disclose that. And no disclosures, they would have to convert it into liabilities. They'd have to deal with the preferred shareholders. Okay, so it's a problem. Okay. Earnings per share is, I have to change that. I think I may have, it's, what is it, 150, I think. Okay. And then no dividend, or actually paid dividend. We didn't pay, but we declare dividend. $40,000, but not paid yet. Okay. Then we have the entire $100,000 bank loan was used to perform the leasehold improvement, amortize about 5 years, no renewal of the lease after the expiration. You need to give that to the shareholders or the bank because they know that the lease wouldn't qualify for the 10 years. Okay, amortization. The cash flow from the operation is positive, therefore it can meet its all short-term obligation, and the tax assets arose from these are the difference from the this is, I classified it as a current assets. You might classify it as a long-term assets because these assets really, might roll over for the life of the asset time. So the classification of the asset could be an issue, but for simplicity, I chose that to current asset. I chose that as a current asset. Finally, but not last. Okay, so remember HST, very important. You need to know this. There are many ways you can do HST, actually 3 ways. So general method, simplified method, and quick method. So each method has, it brings value to the customers or clients. So you'd have to know which one to use. You can't change it. It is very unethical to change it every year. So unless it's really needed, because it suits your client's pocket, doesn't mean you should change it. You should stick to one policy unless there's a need for it. So again, we have this retail division. This went down. Okay. reason. With this. Okay, so oh, so we have the cost of goods, HST collected through sale as a cash. Uh, so, and I showed it differently, so you don't have to look into that cash in, cash out. But so, that's right. Hold on a second, my cell just went. All right, so the HST can be done in a various ways. So this best matches this practice. So, and the way I usually follow, this is very simple. What you do is you could you HST collected from the cash sales or sales. So there's a cash in. So in this case, from the retail division, they had 500,000, 13% at a rate, cost of goods sold. Okay, so 125,000. Just to give you an idea, okay. Now, this could be different. This could be, inventory purchase, right? Inventory purchase. Okay, so I just showed you that for simplicity, but I didn't keep any inventory on hand, so we assume that everything was sold out, so nothing left. So so that is 125,000 times 13%. Remember the tax rates in Ontario, it's either 13% or 8% PST or 5% GST, okay? So the HST includes of HST equal to GST 5% plus PST 8%, okay? So we have HST 13% equal to GST 5%, PST 8%. So it's either that. So either it's HST 13% or a GST 5% or PST 8%. Okay. So you gotta follow the what would be the amount. Okay. So you have the now in this case the insurance from the retail shops, they have a tax rate of 8%. So remember, these are expenses highlighted in red is your expenses, okay, cash in. These lines will trigger an ITC, okay? What ITC stand for is input tax credit and HST paid as a cash. So this triggers the input tax credit, okay? So the sales amount 13%, so HST paid, we collect 1,000. And then the retail operation rent, we paid HST to the landlord, okay? And that is, you can see that this is over here, okay? So how it's calculated, you just simply multiply this by this, tax rate, okay? So this, it shows that 125,000 times 13%, okay? And then we have the vehicle and so forth. Same way, you'd have to bring this up to long term, so right there. The same with the export division, okay? Cash in, HST collected, HST collected and HST paid, okay? That's the difference. Very simple. And we have the administrative expenses, okay? So you'd have to see what fits into line one. That is 104,000. Okay, well, that is this is the total amount you collected. How so? Okay, so if we add this 39,000, okay, the black numbers, you can see that these two, highlighted this. So always line one is what you collected. Okay, so that is line one, highlighted in yellow. It's called line 101, 101, and everything else, the red ones, whatever you paid, is actually line 109. Now there is no special circumstances here, so there is no other line. Okay, so you could take a look at it, what it looks like. So this is what it looked like, your HST form. It's called goods and services tax or harmonized sales tax, GST HST return. So you'd fill out your business number. So this number would come from your CRA, and it would be RST 00001, or PST 00001, whatever it is. Okay, so in this case it's HST 001, whatever it is. Okay, so you just put the HST number there, your name, you fill out the line 101, the cells, from the cells, and you'd have to fill this out. We don't have any special circumstances here at that tax credit, so we didn't have to fill this out. We just simply did the line 101 to line 105, and then line 106 and 107 to line 108. The difference between 105 and 108 is 109. That 109 came right straight to line 113B, because there is nothing really there. I didn't want to show you that, how that works. Okay, so this is how it came up to. I just want to show you the quick method, how it's done. So this is a quick method return. It's completely different. It's not the same, but this is how you do the quick method. Okay, so it's a calculation. It's done differently. Okay, so don't try it. It's kind of tricky. So don't if you know how to do it, but it benefits, it brings value. Okay, but this is not the quick method for our example. Okay, this is different. It's going to show you how the quick method is done. Okay, but I won't get into the details. So you can see that it's where did that go? Oh, I closed that. Okay, so anyway, so the quick method, it starts with 0.88%. Okay, so you know how that works. The sales times the given rate, which is 8.8%. You'd have to look up this number every year. I don't want to discuss that because sometimes this value can change because of the CRA policy changes. So and certain things, you'd be given certain ITC, but you'd have to qualify for that. Okay, so I really don't want to get into that discussion now. So the HST, after the cash paid, the HST collected less the cash paid, this would trigger an payment to HST, payment to because you collected more than. So let's say this was, so if you collected 80,000, oops, if you collected 80,000 and you paid 100,000, okay, the government have to give you 20,000 back. Okay, and that you need to address that through your accounting policies. Okay, well, not policies, but accounting recognition, how you want to classify that receivables. Okay, but that's basically it. Cash in HST collected, HST paid, special circumstances. I'm not gonna get into the details of it because you really need an accountant like me to help you with that. Okay, so let's take a look at this. So again, my name is Mijanur Rahman, and this includes the presentation of the basic discussion. This is a basic presentation. This is a presentation of accounting or financial statements. This is not a tax preparation. However, I did show you how to get to the tax preparation. Now, each line you would, as you go through the accounting policy, you'd have to go through when I prepared those, I would have to, I ran the situation back in my head and apply those. So you'd have to learn how these accounting policies would affect you, okay? So the cost of goods sold, okay, how it's recognized, what to do with it, what policy to follow, okay? The let's see here. On the revenue recognition policy, okay, if you sell credit, how to, or it's a long-term contract, how to recognize the revenue, you'd have to know that, okay. So you just, construction industry is one of those industry that requires revenue recognition. The expense recognition, whether it meets the expense criteria, okay, you'd have to know this, okay. You'd have to know the depreciation policies, okay? You'd have to know the cost of goods sold policies, the inventory, how to calculate them, how, what's in hand. I didn't use the inventory account. I assume it's what's bought, the whole thing is sold, okay? So, it's not, again, the FOB shipping point versus FOB destination points. You'd have to know this. How that affects your income statements, or or your recognition of the expense, okay. You'd have to know the CPPEI, how to deal with this, the ESA, Employment Standard Act. You'd have to know the comprehensive, what goes in the comprehensive income statements, okay. You'd have to know how to, whether if you're providing audited statements, what to do, okay? What to choose. If you're providing notice to readers, what to disclose to the shareholders or the users of the financial statements. Cash flow, okay? What goes in the cash flow, how to prepare it, what method to choose from, okay? Tax preparation, the whole tax preparation boiled down to one line, okay, as you can see here. Just one small line, or probably a simple section, okay, on the income statements. On a balance sheet, just one or two line, okay, tax assets or tax liabilities, something that you need to know. You also have import taxes. I didn't discuss that here, but you may have to learn how to use that. But you could talk to your accountant. If you have any questions, concerns, you want to talk to me, you want to retain my services, please feel free to contact me. This is my number. The best way to get in touch with me via email. I hope I was able to help you with certain things. And this was a bit of, it was really long session, nearly 2 hours, 39 minutes. But I hope, you get an idea how that works. But in the next video, I'll show you the simplified version of it so you could get the idea. But this is, this will give you an idea how to prepare, how to read financial statements. It will give you the expertise to prepare it, okay? Okay, well, thank you very much. Once again, this is Mijanur Rahman.